Welcome to our weekly Forex forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you trading involves risk of loss and is not suitable for all investors. Before we get to the charts, I'm going to leave you with this thought. Bill Williams said it, trying to change your trading without first changing your mindset is like trying to convince yourself that a merry-go-round has a destination. That's absolutely true, not just in trading, but really in life. If you want to make an outward change, that change has to come from within. You have to have your mind made up that that's the right thing to do, and that's the only way we know that then you'll get it done. Hey, let's go to the charts. First chart, the Australian dollar. Here's a weekly chart. You can see price did drop below 80 even. We've been calling for that for a long time now. It's within support zone. You see those lines on there. I'll drop down to a daily chart, see them a little bit more clearly. That denotes support for us. And we can have a line on the chart and we can say it's support, and that's good and fine. But really, until the market starts showing that it's respecting the support, it's just a theoretical level to us right now. Nonetheless, we think this is a very interesting area of the chart to watch. We love the exhaustive momentum down. You see here the market dropped sharply, but we're going to have to see how it behaves. Let me go to the future so you can see the volume. This is what we'll look for prior to starting a campaign of dollar cost averaging this market. And we talked about that. Well, we've been talking about that for a couple of months now. On the way down, we were saying, we're bearish on the Australian dollar. We see it going below 80 even, which it has. Now you can see in the futures, there's the 80 even level, how significant that was. Price continued to bounce off it. Now you're below that 80 even level. We love that. What are we going to look for now prior to starting to dollar cost average it? Well, we like the big volume down. We like the big surge. You see, you still have pretty good volume in this market. Good momentum down on heavy volume. Healthy bear market, right? What we're going to look for, though, is we want to see volume start to taper off here, and smaller ranges. That's a big range right there on heavy volume. You don't want to get in the way of that. You want to continue to sell rallies short term. However, when we see these ranges start to shrink up again, and we see our average true range start to shrink, and more important, the volume start to taper off. When you see very small ranges, very low volume, that's when we're going to take a serious look at this market as far as starting to accumulate it. Not till then, though. However, back to that Forex chart, a very interesting area of the chart, and we think it's worth starting to take a look at gearing up towards dollar cost averaging this guy. Don't want to do it yet, though. You want to wait till the ranges shrink, and most important, the volume shrinks, and then we think you can go in there and actually start to accumulate this guy on cash positions. Though you don't want to start to accumulate something with leverage, because if you're wrong and it keeps going, boy, that'll hurt. Next market, the dollar Swiss. We said last week that if we like the dollar Swiss before this big sell-off, we love it now. Here, pop out to a monthly chart to put that in perspective, and you can see that we talked about that the market dropped down into a buy range. Now we see what happens on the daily. On the daily chart, we said we like that market. On the long side, look, it put in a higher low right there, right? You can see it a little more clearly on the 4-hour chart. The market put in a higher low, and guess where it stopped at? Guess where the market found support at? Right on a 2/3 level. That's important to us because, as Robert Ray said in the Dow theory, a market can retrace up to 2/3 and still maintain that overall direction. That's exactly what you saw here in the Swiss franc. So Swissy, we still like it on the upside. Next market we'll take a look at will be the dollar index itself, and we've been bulled up on this market for a long time. Big difference between an investor and a trader, that's for sure, and we've had our investment hat on in this market for over a year or so. We just continue to hold that same boring long position, but boy, look at how that guy's been growing. Take a look at the monthly chart here, and you can see, man, nothing but upside in that market. And from our perspective, there's growing upside too. There's still plenty of more room on the upside, and we think with everything going this market's way, we think par's in the cards, and we think probably much more beyond that too. 105, 110. So nothing but upside for the dollar index. So we would see that to continue, and that's going to perpetuate the bear market that we're seeing in commodities. and we'll get to that shortly. So dollar bull here to stay. That's actually good news for consumers because it's going to mean lower commodity prices across the board, and we're really seeing that in when we go to fill up the gas tank, and we're seeing it at the grocery store. Food prices going down, commodities really on the ropes, and we'll cover that shortly when we cover the gold market. Next market, however, the euro US dollar. The euro really just collapsed. Boy, that's good news for US tourists who want to get over to Europe. Some folks maybe never been there before. This would be the time to do it. Wouldn't mind going to Ireland myself now. When I see this euro is so cheap, not a bad idea to maybe go abroad, right? And here's the monthly chart, and you can see that you really see the spill off here, just the collapse. We think 110 is in the card, and then from there par to Europe still has plenty of troubles. It's not nothing's etched in stone that they're going to get through that as smoothly as the U.S. did, although we think that'll probably be the roadmap, the blueprint, that how the Fed got the U.S. economy back on track. We think that the ECB is going to do the same thing over there. But for now, however, the U.S. just has a distinct advantage against Europe on so many fronts, and we think that's going to lead to continued weak euro. And you can really see on this monthly chart the collapse of the euro in the month of January 2015, and we don't see that trend about to reverse anytime soon. So we think there's a lot more room on the downside in the euro. And again, that dollar strength, that's going to continue to contribute to a bear market in commodities across the board. Speaking of commodities, there's your gold market on the monthly chart. Looks good, held support. It'll be interesting to see if it can claw higher. However, when you drop down to a weekly chart, you see a clear pattern of lower highs here along the way. In fact, you see that orange box, that's a sell zone you're in right now, and we're definitely interested in setting up shorts in there. Here's the daily chart. You can see got all the way to the top of that box. You can see a couple of wicks up there, and then you had a red candle on Friday. That's the top of a box. We think that if there ever is a time to take a short position in gold, use leverage, now would be the time. So we like short in gold here because it's a pretty low risk trade for us. All you really want to do here would be risk it just a little bit above last week's high. So you can go short now, risk it a little bit above that high. You're looking at a $15-20 risk on the trade. On the other hand, if we're right and this market goes back down to the summer lows, to the fall lows, and we think that's pretty likely, then you got a ton of room on the downside, right? Really like short gold here, regardless of the risk reward on it, but it looks to us from our perspective that you have a tremendous risk reward setup here, that risk a little bit to potentially make a lot. We'll see where gold comes in, but we think it's a cyclical bear market in commodities, gold being a commodity, and we'll go across the board here and show you some of the other commodities. Here's crude oil. Obviously, you've had a collapse there. Let's look at the monthly chart. There's crude oil. Look at the big collapse there. Next market, next commodity, we'll show you copper. Copper had a big down week this week. Look at copper's just starting to collapse now, so a lot of room below in the copper. You broke that long-term trend line there. Copper's lower. Here's soybeans. Soybean very important, obviously, for the food industry. And look at soybeans. They collapsed pretty good in the early fall, and now it looks like they're breaking out. They're starting to turn lower again. So soybeans, a lot of room down below. Really, commodities overall. Here's a quick look at the corn market too, and you can see corn has had quite a lot of downside here too. So you can see that that secular bull market we were in has come to an end in commodities, and now you're looking at the opposite. Before you had higher lows on the way up, identifying a bull market. Now you're looking at lower highs on the way down, and that's a bear market. Oh, the silver market too. Silver market, a good leading indicator for the gold market. And you can see how much weaker that market is. You had a bit of a recovery here in the last month. We actually would see this market as having been one where, here, let me show it to you on a weekly. The $20 level was pretty important. Just below $20 is pretty important. You can see that support. It was found in there. Well, when it broke that support, the market traded down all the way almost 14. We see it coming back and just testing that area. We see a classic. We see the potential for a classic setup in commodities in markets where the old low becomes the new high. So we're going to look for potential support becoming resistance here, and likewise silver being in a position to flash a sell signal also. Last market we'll cover will be the dollar yen. And there's dollar yen. We actually think you have some downside here now. Finally, long term, when you look at the monthly chart, you'd have to go all the way back to the all-time highs here. Well, I should say the modern highs here back in the late 1990s and 1996. You retrace a full 2/3 of that move. So massive rally here, retrace a full 2/3 of that guy. You're stalling at a GAN 5/8 line right there. So we think that the upside in the dollar yen now finally somewhat limited, and we'll keep an eye on that. But that certainly doesn't mean this market can't go sideways for a long time at those levels. So we're definitely not interested in getting short by any means. If anything, we're still taking a look at short-term buying dips, short-term opportunities to buy the dips. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you again next week.